Good morning, everyone. Really pleased to welcome you to our quarterly update, looking at our latest findings from Robert Half's Jobs Confidence Index in partnership with the CEBR, the Centre for Economics and Business Research. Today with us, we have Nina Scarrow, Chief Executive at CEBR. She'll be going through the latest JCI data for us, followed by a Q&A off the back of the findings. But before I start, I'd like to just share some reasons as to why we've commissioned this unique study. So whilst businesses and consumer confidence are regularly measured, analysing worker confidence through a macro lens in the context of job creation, security and progression can reveal deeper insights into the state and stability of the labour market. And although traditional measures of labour market health like unemployment and job vacancies are valuable, the figures alone are not enough to understand the UK's increasingly complex labour market. And that's why we've partnered with the CEBR to create a quarterly Robert Half Jobs Confidence Index. Keeping a finger on the pulse of current trends, employers can create a more purposeful talent acquisition and learning development strategy, whilst job seekers and employers can make better informed decisions on how their goals on things like remuneration, work model, flexibility, as well as upskilling and progression fit with the wider picture in the labour market. So I'd like to introduce our guest speaker, Nina from the CEBR. As I said, she is the Chief Executive, and Nina is regularly interviewed on Bloomberg and the BBC. She also often presents her research at public events around the UK, but also globally across Europe, Asia and the Middle East, as well as analysing and authoring bespoke reports and comments on the labour market trends regularly. We're delighted the CEBR is working with Robert Half on the Job Confidence Index. We've been doing this now for the past year. So without further ado, I'd love to pass over to Nina, and she'll take you through the report.
Thank you very much for the introduction and also for partnering with CEBR for another quarter. Before I take us through the latest results, a little bit of a reminder in terms of the background on how the index is compiled and why it's a really unique, timely, and important measure of the labour market. So when we look at our quarterly readings, and what we will be discussing today is Q4 2023. So it's a very timely set of measures, taking a backwards looking approach only a couple of months ago. It's also very unique in terms of not only the metrics it considers, but also in the way that it combines them to provide both a detailed but also high level and comprehensive look into the labour market. And what I think makes it particularly authoritative is the is the wide range of metrics that it combines. So it has 4 pillars, which are the job security confidence, pay confidence, job search and progression confidence, and macroeconomic confidence. And the index can take both a positive and a negative reading. So if the reading for the quarter is above 0, it means that job confidence is higher than the long-term average. And if the index takes a negative value, it means that confidence is below the long-term average. Now, there are no fixed limits in terms of what value the index can take, but we do say that the normal sort of range is between -30 and 30, just based on where it has traditionally sat, looking over the course of the index. So with that, if I take us through the results for the quarter 4 of 2023. So the job confidence index increased slightly in the 4th quarter of last year to 46.5. Now, this actually follows a small downtick in the previous quarter, but overall, we have in recent years seen very, very high readings for the index. So as I mentioned in the introduction, we consider the normal range to be from -30 to +30. So given that the index has now risen to 46.5, does show just how robust the reading is. And sort of if you look at there on the graph at the recent history, we're seeing some very, very high figures, and last quarter was no exception. So what sort of are the subcomponents? As I mentioned, we'll talk through job security, pay, search and progression, confidence, and macroeconomic picture in a moment. But the level of the increase compared to the previous quarter was 4 points. And of those 4 pillars that I just listed, all 4 of them stood in positive territory, and 3 out of the 4 of them increased quarter on quarter. So again, what we're seeing here is generally a picture of quite a lot of confidence. And in fact, we have seen the overall index stand in positive territory for the past 13 quarters. So I guess a rare example of 13 being a lucky number in this case. So how have the 4 subcomponents changed over time? So I mentioned that out of the 4, 3 have increased, and the one that bucked the trend was the search and progression confidence, which, as you can see, the numbers there on the slide decreased relatively sharply. So it actually fell from 34.7 in the third quarter of 2023 all the way down to 4.9 in Q4 2023. And we'll speak in a moment on what was behind that decline. But all other 3 measures performed quite strongly. So job security confidence increased by more than 32 points. Pay confidence also increased by just over 8 points, and macroeconomic confidence increased as well, which I will cover in more details when we just in a moment go through all of the sub-indices. But it's quite interesting that the macroeconomic confidence sub-indicator increased, given that a lot of recent economic headlines have actually been quite negative. And we also now know that the UK was actually in a recession at the end of the year. But it seems like those sort of hard measures of economic performance haven't actually necessarily fed into the confidence figure. And then, as I said, taking those 4 sub-measures together into the headline number saw an increase of 4 points. So looking at job security confidence first, which looks at job security confidence. So this looks at both a survey component and also some official statistics. So if we look at the 2 graphs there on the screen, we see both the measure of UK unemployment and also levels of temporary work. And if you look at sort of what those metrics are doing there at the end of 2023, they are both showing a downtick. And if you sort of look at where those lines are compared to historic levels, they are both at very low levels. So it's quite a robust picture in terms of what the labor market is doing. So it is perhaps not surprising that the job security confidence indicator is standing at such a high level overall. In terms of the survey component that goes into this pillar, this metric has actually ticked down to just over 56%, which is the share of employees that said they feel confident about their job looking ahead to the next 6 months, which is a downtick from a level of 58.4. But again, that is more than half of the respondents and still a very healthy figure. The second pillar looks at pay confidence, and total pay growth slowed, but real wage growth remained unchanged due to falling inflation rates. And this has been a really important dynamic feeding into the pay confidence sub-indicator. And if we look at the pillar score, it increased on the quarter and remains above the long-term average. And as I said, this is despite total pay growth actually slowing, but real wage growth still being a encouraging figure given that inflation is finally moderating. Now, the only indicator in this pillar to contribute negatively to the overall pillar score is labor productivity. And productivity has been a very important topic in the UK for years now. And there is rightfully a lot of focus in terms of what to do to boost labor productivity. And this matter has only become more pressing during the COVID era, which saw a lot of workers leave the labor market. It also saw a worsening in measures such as the long-term sickness rates. So it's perhaps unsurprising that labor productivity contributed negatively to this pillar. I think this is also a good moment and a good pillar to point out the importance of this publication, the Job Confidence Index overall, given the difficulties with the ONS's labor force survey, which is something we would normally be counting on to contribute to this pillar. And in fact, we are still relying on that data from the ONS labor market to feed into this measure, but they have been having some difficulties with that publication and that official statistics owing to lower sample sizes, which I think creates an even more important space for publications like this Job Confidence Index to fill that gap and sort of tell us what is happening in the moment in this space. Now, moving on to pillar number 3, the job search and progression confidence, which is the one pillar that sort of bucked the trend this quarter in the sense that it decreased between Q3 and Q4 2023. Now, despite this quite significant decrease, it is just about positive, standing at 4.9. So a big decrease on the quarter, but still actually a reading that is in positive territory. Now, what is behind this quite dramatic fall is a fall in the survey component of the pillar, which looks at career progression confidence. And that figure decreased from 47.4% down to 40.3%. So at 40.3%, that is still 2 in 5 people saying that they are broadly confident about career progression, but still a notably lower share than the last time around. Now, involuntary part-time work, which is another measure that goes into this sum pillar, also saw a small uptick, and you can actually see that on the bottom right corner there, that small uptick. So this is also something that doesn't bode well for the job search and progression confidence pillar, but it's mostly that bespoke survey element that has contributed to the large fall. So certainly the weakest of the four pillars, but given the overall strength of the measure, even the weakness pillar is actually in positive territory. And then the final of the four pillars is the macroeconomic confidence one. So I mentioned in the introduction that it's perhaps interesting that the pillar is in above zero territory, given all of the attention that the UK recession at the end of 2023 has received. I think my interpretation of why that is, why it may seem like a contradiction, but I actually don't think it necessarily is that confidence is a leading indicator. It does sort of invite people to look at things as they are now, but to look ahead. So it does seem that to be a case that in terms of consumer confidence, but also business confidence, both of which fared relatively well without any major downtick on the last quarter. It seems that as people look ahead, they're actually feeling relatively optimistic despite sort of an economic slowdown at the end of last year. And this seems to be particularly the case for consumers that actually saw an uptick in consumer confidence in the fourth quarter. Businesses actually saw a slight worsening in terms of the business confidence reading, but despite that worsening, the business confidence figure was also in positive territory. Now, if we sort of take a step on from the usual quarterly readings and the sub-indicators and look at something which is a little bit unique and new for this iteration of the index, we've taken a closer look at the impact of AI, artificial intelligence, on career paths. And we've sought out to find out how concerned, or on the other hand, how proactive workers have been in terms of acquiring the right skill set to complement AI, and how disruptive they think, or disruptive or maybe helpful it will be in their career. So there are a lot of unknowns. And in terms of AI, the exact impact it'll have on career paths, on the economy. And I think that is borne out in the survey results here as well. So if we look at sort of how concerned or not concerned respondents were about AI and the disruptive impact it may have on their career path, we see that if we look at over the next year, about a third of people were concerned that it would have a disruptive impact, and meaning that about 2/3, a little bit less, were not concerned about any potential disruptive impact. And then the share of those that are concerned increases the longer the time horizon stretches, which makes sense because the assumption being that the more time passes, a larger role in our economy and in jobs of the future AI will play. So if we look at the next 2 years, that share of concerned respondents rises from 31.4% to 34.4%. to 40% if we look at the 3 to 5 year horizon, and all the way up to just under 45% over the next 6 to 10 years. Now, if you look at the graph in the bottom right corner there, which looks at the percentage of employees that are very concerned about a disruptive impact of artificial intelligence, the figure for London really jumps out. So London is the region with the highest share of concerned respondents at 37.4%. And the next region is down to 25.9%, so quite a bit less. And I would say that the reason behind this is the labor market structure in London and the industry makeup in particular. So there are a lot of sort of knowledge jobs, a lot of research jobs, a lot of the kind of jobs that you can most easily imagine being disrupted by AI, jobs in professional services, in the legal space, in financial services. And given the concentration of these industries in London, it's perhaps unsurprising that there is such a high share of concerned workers in the capital region. And sort of sticking with the topic of AI and looking at what people might do to prepare themselves for any potential disruption. So we see that a number of workers are either counting on their employer to provide them with the opportunity to take on AI-related training and upskilling. And also a lot of workers are planning on taking this under their own wing, so to speak, and proactively looking to retrain and to move to a role that is more AI focused and technology focused. So if we look at within the next 2 years, around nearly a quarter, 22.8% of people are planning on retraining and moving to a role or at least a field that is more AI focused. And that rises quite significantly to just over 40% if we stretch the time horizon to 5 years. Now, the results aren't very even, depending on what kind of breakdown you take for the data. So if you look at these results by age, I think it shows an interesting, although perhaps unsurprising result that younger workers tend to be more proactive in terms of proactively upskilling. So that figure is the highest for 18 to 34-year-olds, and then at 60%, and then gradually decreases for older workers. And perhaps worryingly, given the sort of already sometimes uneven nature of the labor market, graduates seem to be a lot more likely than non-graduates to plan to proactively upskill in terms of AI, which could create a little bit of a red flag looking ahead and the positive but also sometimes unequal impact that AI can have. And then at last, if we look at a little bit of a forward look in terms of the macroeconomic picture. So I've mentioned several times that the economy was in a recession at the end of 2023. But I think there's a little bit of caveating that's needed there. It was a very mild and shallow recession. And if our forecasts for 2024 are considered, we actually think that the UK is probably already out of that recession, the recession being defined as 2 consecutive quarters of economic decline, which would have been the 3rd and 4th quarter of 2023. So we are actually expecting to see the UK economy grow in 2024 in the 1st quarter, which would mean that the UK is already out of the recession. And we're also expecting to see a positive rate of growth for 2024 as a whole at 1.1%. And one of the very important considerations contributing to this rate of growth, which is positive, although still relatively low compared to historical averages, is the inflation dynamic, with inflation finally tapering off and falling to close to levels of the 2% target. And another important factor in this expectation of growth is what we've been discussing here today, which is a very strong labor market, which has also been borne out in the job confidence index we've been discussing here. So I will leave it there in terms of the presentation, but I will be happy to answer any questions.
Just a few questions for you, which we'd be really interested to get the insights on, is so looking at the results from this time round, in what ways do you think this continues to be a unique economic and labour market cycle?
I think we're still seeing a very unique set of dynamics. So something I mentioned is that although we are expecting to see positive economic growth in 2024, it's still a relatively, modest rate of growth of around 1%. It's low by historic standards. So we're seeing an economy that is performing relatively, in a mediocre fashion, let's say, compared to historic levels. Yeah. But on the other hand, a labor market that is very, very strong, very, very robust. So it's not often you see this dynamic. Now you might say, well, the labor market might be performing with a lag. So you might in the near future see sort of a cooling of the labor market to go along with the softer economic picture. But we're not necessarily expecting that either. We actually think we're going to continue seeing quite a tight labor market. So it's definitely a unique set of dynamics.
Yeah, great. And you mentioned, you've already touched on this, and you talked about the recession, and many people say or suggest that we're already coming out of it, and I think the prediction is that we'll grow in Q1. But what's your view on the announcement of the recession in Q3, Q4?
I do agree with the view that we're probably already out of the recession and that we're not expecting it to be the beginning of a protracted period of economic decline. But having said that, it's not something that should be brushed off either. The cost of living crisis, the higher interest rates definitely have taken their toll on economic growth. So even if we are out of the recession, we're not expecting to see particularly strong rates of growth. So the headlines around economic slowdown shouldn't be ignored, but I would agree that we're probably already out of that end of 2023 recession.
All right, that's good to hear. And talking a little bit more about the index itself, what are the reasons that there still seems to be high job confidence given some of the economic uncertainty, things like recession at the moment? We're still seeing higher job confidence. So what do you think is driving that?
I think what's driving jobs confidence is that people that are looking to move roles or to enter the labor market are still finding themselves in quite a strong position, even if there might be wider signs of macroeconomic weakness. So I think there is a lot of relatively complicated factors behind this. One of them will be skill shortages. I think there are a number of industries and skill sets that are very in demand. So people in those particular industries, we've talked about AI, a lot of very important tech skill jobs. So there is a lot of demand and a lot of areas with skill shortages. So those people that are looking to move or start new jobs are still finding them in quite a strong position. We're also seeing, I mentioned this as well during the presentation, stagnant productivity, which means that demand for labor is quite strong, in the sense that if there aren't a lot of leaps in terms of increasing productivity and the economy is growing, even if it's at moderate rates, it does mean you will need more workers to do those jobs and to keep the economy growing. So despite these sort of macroeconomic hiccups, the opportunities are there, and very importantly, the pay rewards are there for people that are in the right position, which I think is helping keep those confidence figures high.
So would you say that job seekers and employees are still in the driving seat at the moment?
I would say that, the caveat being that vacancies are a little bit coming off the boil, but they are still at a very high level. So I do think that many candidates will find themselves in quite a strong position. Now, of course, it will depend on one's personal circumstances, but at a high level, I would still say it is definitely a better time to be somebody searching for a new role than it has been in many years prior to this most recent uptick.
Yeah, I'd agree with that. And wage growth is still above inflation. So what is the CEBR's prediction going forward for the likelihood of further wage growth?
So we do think that wage growth is going to moderate over 2024, but even at those moderating rates, we still think that the rate of wage growth is going to be twice that seen in the lead up to the COVID period. We're also expecting wages to continue growing comfortably above inflation, and continue to do so in the medium term as well, not just in the immediate future. So a lot of these challenges around skill shortages, around maybe any mismatch between skills available and vacancies, those are things that are going to take years rather than months to resolve. So for that reason, we are thinking that in the next couple of years, really, wage growth is going to remain quite robust, if not as high as we've seen in the immediate back history.
Right. Yeah, great. Thanks for that. I think the section you did on the AI revolution was really interesting, actually. So which part of society do you think will be most impacted by that? I think if you look at some of the data, you suggested that there was quite some significant regional differences, particularly in London. You touched on sort of some of the reasons for that, but what part of society do you think will be most impacted by that?
I think we can break down the impact in a few different ways. So one statistic that jumped out at me is that 52% of graduates are expecting to be proactive in terms of AI upskilling, but this drops down to 37% for non-graduates. So it seems that people who have attained higher levels of education are also planning on more proactively upskilling, which I think could have some really, it's important to keep an eye on, because you could have some very real impacts in terms of inequality. So it is definitely something that's important to consider as the entire economy learns how to adjust to increasing AI usage. And also, there's already been some interesting dynamics in the labor market in terms of age brackets. So one of the impacts of COVID has been the fact that a lot of older workers have fallen out of the labor market. And something we're seeing for that demographic as well, older workers, is that they are less likely to proactively upskill in terms of AI. So for the over 55s, that figure in terms of those looking to take on a proactive approach was 28%, which is lower than for 35 to 54-year-olds, which is 43%, and that is lower yet than the 60% figure for 18 to 34-year-olds. So although you could say, well, it makes sense that sort of younger workers are a part of the labor force that is most likely to proactively upskill, given that we've already lost out of the labor market a lot of older workers, it would be quite important to not lose even more of that segment due to a skills mismatch in terms of AI.
Were you surprised? I think the figure was 22.8% of people were considering retraining and move into an AI-related role in the next 3 to 5 years. That was quite an interesting stat, and I think be interesting to know from you what you think the impact would be on traditional industries given that figure.
Yeah, I think maybe if I was surprised, it would have been in a positive sense. You know, that's almost 1 in 4, which tells me that people are very much alive to the opportunities, but also the risks that might be coming their way. And if anything, it's good if people are looking to sort of future-proof their jobs and put themselves in a position where they can do the most to take advantage of what is probably going to be a big area of change, but also a big area of opportunity. I do think in terms of the sectoral impact, it also might be the case that those industries that can use AI to boost productivity might be in a particularly strong position going forward to offer their workers higher salaries if they can take full advantage of AI and therefore make themselves even more attractive for the workers that they still need, and particularly those workers that can basically use AI as a tool, as an enhancement tool rather than sort of in the replacement sense. So I think it could have some very important impact in terms of how it changes the structure of the workforce in particular industries, and which industries end up emerging as actually more attractive and which ones as less attractive to workers.
Makes sense. So look, appreciate the detail on some more of the intricacies. I think on a, I guess, more general labour market context, what potential risks do you think businesses, especially maybe SMEs, need to be prepared for in the next 6 to 12 months?
Well, we've talked a lot about skill shortages, and mentioned that as something to look at. So we've seen in terms of business confidence, sort of downtick, but still in a relatively strong position, which to me would say that there are a lot of businesses out there, including SMEs, that are actually planning on expanding in the immediate future. And what those businesses will need is an access to a healthy supply of workers, and workers with the right skills. So if we're talking sort of about a 6 to 12 month horizon, I think the transformative impacts of AI are going to be more gradual than if we're talking over sort of the more medium-term period. But something that I would be quite concerned as a business, and especially as a business that was looking to grow, is once we're ready to expand, are we quickly enough going to be able to find and hire and attract the right people? And to make it SME specific, sometimes it can be harder, I think, for SMEs to compete for the right talent in a labor market that is seeing quite high rates of wage growth. So if you are a smaller business that is more sensitive to those kind of expenditure shocks, it is something you will want to keep an eye on, and that could be a restriction on growth.
All right, thank you very much. And finally, be good just to understand, what is your expectation for inflation trajectory and economic growth by the end of this year?
In terms of inflation, we're expecting a pretty significant dip in the spring, which has a lot to do with the change in the energy price cap. But after that dip in spring, we are expecting inflation to certainly not return to the exceptionally high rates of price growth we've seen in the recent period. But we are expecting inflation to be a little bit above target. And part of that is what I've just been saying in terms of upwards pressure on wage growth. And if wages are still growing at above trend rates of growth, that is going to feed into price levels as well. So we're expecting basically inflation to continue to tick downwards, but struggle to return and remain at the 2% target. But that downtick in inflation will contribute to a more positive overall economic picture. So we are expecting an uptick in growth for 2024, but still staying around the 1% mark. So nothing sort of boast off, a relatively moderate rate of growth, but a positive one nonetheless.
Encouraging to see that we've come out of a recession, or should come out of recession, relatively quickly though. So that bodes pretty well for 2024. So I think really grateful for the insights there, Nina. That's all we have time for. Please take time to look at the report, which you can find on Robert Half's website. But if you would like to discuss the findings in more detail, then feel free to get in touch. There will be another webinar next quarter, and hopefully we'll see some more positive change when we come around to doing that one for you. So thanks, Nina, to you and your team again. It's great to be in partnership with you, and we look forward to catching up next quarter.
Likewise, thank you for having me.
Thank you.